All right, I'm just gonna start off here. So for any questions that I see, just to make sure that everyone can see it, I'll make sure to copy and paste the question onto a notepad so everyone can see what I'm answering. So first question someone asked is, what are we going over in the meeting? So basically today what we're going to be talking about is Fibonacci's and how to use it while trading. Fibonacci's is relatively used where you look at price action, right? It's a tool that you draw. You can find it on almost every single trading platform that you use, like Thinkorswim, or if you use TradingView for charts, if you're on TradingView, right? If you look on the left-hand side, this third one right here, if you click it, it's this tool called right over here called Fibonacci retracement. Fibonacci is the full word versus Fib is the shorter way of saying it. But yeah, today we're going to go over Fibonacci's. I'm going to go over like the basic rules that you need to know, the basics, how to use it while trading, a few strategies that you can use, and everything like that. It seems complicated at first due to the complicated like numbers and the amount of numbers that are involved, but I promise you it's really not that difficult to understand. So yeah, all right. Another question we had, which I'm pretty sure I'll just answer throughout the video, the session is, this person asked, the questions he had about Fibonacci's are drawing from top to bottom or the other way around. And he's seeing that, he's getting conflicting feedback. Don't worry, I'll make it all simple for you. And then most important levels, I'll definitely go over that as well. The next question is this being recorded? Yes, it is, but let me also, how do I record on here? All right.
Recording in progress.
Okay, so I have it recording on Zoom and also OBS Studio, so it should hopefully, either of them should work perfectly fine. But with that, we'll get started. Any questions, again, you can feel free to type in the chat while I'm talking, but after I'm done talking, I'll tell you guys can ask any questions, and if you want to get on voice, that's perfectly fine with me. But okay, so what is Fibonacci's, right? A lot of people think Fibonacci is an indicator. It is absolutely not an indicator. It is a drawing tool. Just like, we'll just use TradingView for this example, since a lot of people use TradingView, or they use Webull, which basically uses the TradingView platform, kind of, right? So on TradingView, you can add in lines, or you can add in trend lines, right? And basically, these are called drawing tools, and that's what a Fibonacci is. It's basically a tool. I don't know if you'd really consider this a drawing, but it's definitely a tool. But what does this tool consist of? Basically, what this tool consists of, right? Let me just delete this for now. You don't need to write, so I'm going to show you an example of what a Fibonacci looks like. I'm just drawing it out so you guys can see, but basically what a Fibonacci consists of is different levels, and you use these levels as either support or resistance. And the way you use Fibonacci's, or at least the most common way, and the way I use it, is to find a continuation of a trend, right? And I'll explain. It might sound complicated, but I'll explain everything. So let's say, let's see. Let me find a better way to show this. Let's say, all right. Let's say you have a bullish day, right? That means the stock is going upwards for, let's just say, Apple or whatever, right? Stock is going upwards. This is a trending day, meaning the stock is going in a certain direction instead of a range day, which it goes sideways, right? Go up and down, stuff like that. But a trending day is where it goes one direction the entire day. And it's basically like the bullish momentum or the bearish momentum is the most easily seeable trend you can see, right? Of course, not every trading day is perfect. You might have days where it's just like trending upwards and it'll like come all the way to down here, and then it would be zigzag, but overall it's trending upwards, right? So that's basically what a trending day is. So you would use the Fibonacci to basically help you enter into trades when it's a trading either day or trading scenario, trending scenario, not trading scenario, trending scenario. Now, in a previous video, we talked about the difference of trending and range, and I just demonstrated it right here, right? So if a stock is moving in a certain direction, either upwards or downwards as well, right? When it moves upwards or downwards, like in a continuous movement, that means it's a trending either period or day, right? But if it trades sideways, that means it's a range day or range period. So basically that's the basics. So you don't use the Fibonacci's during a range period because this only helps with trending periods, as I said. So how exactly do we use it? Okay, so let's say this is Baba. It's just the stock that I had up. Let's say we're on the 4-hour chart, right? Let's say Baba, let's say here there's a replay feature. So let's say let's say this is how Baba looks right now, right? We had this high over here. This is called a swing high. And we had this low right over here, right? This is called a swing low. So obviously the trend is bearish, right? You could see that we had the high over here. We're trending downwards. And the trend is bearish. Now, of course, following any movement, there's always going to be a period of cool off. And then following the cool off, usually what happens after is the movement continues in the direction it was going previously. So in that case, right, since this is a bearish movement, we go bearish, have a little cool off until bullish side, and then have another bearish movement, right? Of course, not everything is 100% correct, but this is how a healthy market, or usually what happens in a scenario, trading scenario, whenever it's a trending period, right? So this is the trend. We identified that the trend is bearish. Now, when the trend is bearish in this scenario, that means the most profitable direction you want to be trading is obviously the bearish side, right? You want to take puts or you want to short the stock. And to do that, you definitely want to make sure that you find the best entry, or at least close to the best entry. And how do you find the best entry, right? So in this scenario, you want to find as close as you can to the high, right, of the push up, the cool off, right? And you also want to have it followed by confirmation. Now, the Fibonacci is basically what you use for confirmation. So if you go back over here to the Fibonacci area and we press Fibonacci retracement, since we're looking at a bearish trend, what we'll do is we'll start the plot from the high, the swing high, right, all the way to the closest and the most dominant swing low. So that would be right over here, as I said, right? If you see right over here where my cursor is, this is where the swing low is, right? So we always plot from left to right. It's never right to left. Never do right to left. That's the incorrect way to plot it. That's not how you plot it. You always plot from left to right. So in this scenario, since we're looking at a bearish trend, we're going to be plotting from left to right, and we're going to be plotting from the swing high, which is this high over here, all the way to the swing low, right? So that's right over here. Now, when we plot this, we'll see multiple numbers, and it'll seem very confusing at first, but it's really nothing to become panicky about, right? But when you plot this, you see these levels, and I'll go over them really quickly. So you see this 78 percentile level, the 61 percentile, the 50 percentile, the 38 percentile, and the 23 percentile. Now, basically, these are all percentages, right? As you heard me say the word percentile. And what it's saying is, since we plotted it from the high to low, let's say from this low, right, where we plotted the swing low, all the way till this level right over here at the 23 percentile, it's basically saying it's a 23% increase from the swing high to swing low to the current price, right? That's kind of like a complicated way of thinking about it, but you really don't need to know that part, but that's basically what that means. So each level is basically a percentage. So this is the 23 percentage, this is the 38 percentage, 50 percentage, 50%, 61%, 78%, and obviously the swing high in this scenario is 100%. Now, if we just go away from this scenario, and if we, let's say we're looking at a bullish trend, right? We'll look at the swing high in the scenario over here, and we'll plot it to the swing low, sorry. We'll plot the swing low over here, and we'll plot the swing high over here, right? Let's just say we're over here, right? This is where the current trading day is. You'd plot from left to right again, and since we're plotting a bullish trend, we're going to be plotting the swing low to the swing high. So again, basically, the way this works, right? So if you're plotting the Fibonacci on a bullish trend, the way you want to be plotting it is from left to right, right? As always, that's how you always plot it. And you always plot it from the swing low to the swing high, okay? And you could see that right here. You could see that we started off the plot in the swing low over here. If you don't know what swing low means, it's just basically the lowest point during a given time the stock reached to, and then swing high is obviously the highest point in that period of time. So you could see that we plotted from the swing low, right, to the swing high. And I'm sorry if you guys know this, but I obviously need to know the people who don't. I need to obviously teach the people who don't know this as well, and then we'll get into how to trade it. And then the bearish, right, is same thing, but obviously just inverse. So you plot from left to right, but instead of starting at the swing low, you start at the swing high, and you plot it to the swing low. And you can see that we did that right over here by starting off the plot at the high over here and ending the plot over here. Okay. So now we're going to go back to this scenario right over here, okay? So one question, why am I on the 4-hour chart? Well, Fibonacci's just like any other tool, any other drawing, or any other indicator, the higher the time frame you're on, the more accurate the tool or the indicator is, right? Now, for example, if we use the 1-minute chart and let's go away from Fibonacci's for a second. If we use the SMA or the MA or the MACD and stuff like that, the 1-minute or lower time frames, they're always clouded with noise, and with noise comes a lot of hesitation in your trading, and not even that, it also leads to a lot of improper or incorrect trades, right? So you always want to stick to the higher time frames, and what I mean by higher time frames are 15 minutes and above, right? Basically, the better options are always the 4-hour, the daily, or the 1-hour, right? Or 2-hour. 30 minutes and 15 minutes, a little bit on the shorter time frame, but it's still, a little bit bigger. It's a bigger time frame compared to 1 minute, 3 minute, and 5 minute, right? So that's why I'm the 4-hour right now. What we want to look at is bigger movements, right? We don't want to look at small movements that are probably only going to yield us like 5% or 3%. We want to look at big movements that will yield us 40%, 50%, and have a better risk to reward ratio, right? Because with smaller time frames, you have to realize that most of the time you're gonna have worse risk to reward ratio, meaning that there's more risk involved versus the projected profits you could get from it, right? So that's why I'm on the higher time frame. That's why I'm on the 4-hour chart. Now, the way this works in this scenario, right, in the bearish scenario where we plotted from the high to the low, is that these levels, the 23%, 38%, and so on, these work as resistances and key levels. So these are key resistance levels, right? Keep that in mind. And keep also in mind that the way this tool works is we try to find the continuation of the trend. And in this scenario, we're trying to find a continuation of the downtrend, right? So we had this downtrend and we're having to cool off, which happens, right? So we're waiting to see, we're trying to find a good time to enter after the cool off is over, right? And also, not only does the Fibonacci show when to enter, it also shows if it's actually the counter movement is a cool off or it's actually a reversal into the other direction, right? Because we're not 100% sure that the trend is going to continue into the downside, right? It very well could just continue into the upside. And the Fibonacci also helps us basically identify if, okay, the trend is actually no longer to the downside, it's going to reverse to the upside, right? So it helps us avoid getting into the wrong trades. So The way this works, as I said, is these are resistances. Now, going back to what someone asked earlier, obviously there are multiple levels here, but there's some levels that are not really important to really look at. And in my opinion, that's the 23 percentile, right over here, the 23%. It's stocks relatively don't really respect it as much, and usually if you get a cool off and it only goes to 23% and then continues to downside or whichever way you're looking at it, it's not usually a huge movement that follows afterwards. And usually what happens is the stock usually, I said usually like 10 times in that sentence, but it would respect the 38 percentile, the 50 percentile, and the 61 percentile. These three levels right here are, in my opinion, and in most traders' opinions, are the most important levels, or the levels that are respected the most, right? So if you're on TradingView, you could easily you could click on, let's say you draw it out, you could click on the Fibonacci, you draw it out, the retracement, go to settings for the tool, and you could unclick the 23 percentile and that'll remove it. And then once you do this, it'll save that, and then whenever you draw another Fibonacci, right, it won't have the 23 percentile. Of course, you could keep it on there, for your peace of mind to see, just if you want to keep it, that's totally fine. It's not wrong to keep it, but it's just, you really don't need it, in my opinion. And the more clutter you have, the more hesitation you find in trading. So, okay. We're currently here. Let's say this is the current trading day for BABA, right? We're over here right now, and we drew out this Fibonacci. We could see that BABA is trending upwards, and we predict this to be a cool off, right? This trend right here, this bullish trend, we predict it to be a cool off. Now, as I said before, we're waiting for a reversal into the downside. Well, okay, what do I need to look for to know that there's going to be a trend into the downside and not just a complete reversal into the upside? Well, okay, this is where these three levels come into important. This is when these levels become important. Now, let's say the stock was BABA was to come here, right, and then we start pulling up. It could reject at the 38 percentile. It could reject at the 50 percentile, and it could reject at the 61 percentile. Now, keep in mind that the higher the level you go to, the smaller the movement is to be followed afterwards. Now, what I mean by that is, let's say, sorry, no, it's the opposite way. So let me just basically explain what I'm saying. So let's say BABA reverses into the upside and it rejects right over here. Usually what happens is the movement followed is actually pretty strong, right? Now, let's say instead BABA retraced all the way to the 50 percentile. It'll be strong, but there's more likely a chance that it will hiccup again, along the way. And of course, it'll be even worse for 61 percentile, right? There'll be a movement afterwards, but you see a hiccup along the way. So the strongest movements usually is when it rejects at the 38 percentile. Now, why is this the case? That basically means that the bearish movement is so strong and the sellers are more powerful than the buyers, right? That the buyers really can push up the stock as high as you'd want it. So as high as they would want it. So that's a key factor, right? You need to look at how strong the momentum is. Now, if the momentum is strong, you would find it usually rejecting around the 38 percentile, the 50 percentile. If the trend is weak, you see it rejecting around the 61 and sometimes the 78, right? The 78, you'll find some rejections, but at this point, the stock has reversed so much into the upside or the opposite direction of the trend that you're looking at that it's really risky to get into that trade, right? So in this scenario, if BABA reversed into the 78 percentile, right, there's a low chance that the movement afterwards will be pretty strong. So you wouldn't want to enter that trade. I personally wouldn't enter that trade. You could always trade according to your risk tolerance, but I personally wouldn't do that. So now, tying into what I said about, how strong the movements would be, we could see here that BABA retraced it broke past the 38 and the 50%, right? But it didn't break past the 61%. It hasn't reached there. We're starting to see signs of reversal into the downside, right? You can see these bearish candles following this bullish candle we have, right? This bullish momentum. So this is when the waiting game comes in, right? So what we can do is we can use the levels that are broke through as entry points. Now you could based on your risk tolerance, you could do two things. One, you could, since it broke above the 50 percentile, you could try entering after it breaks below the 50 percentile. That's obviously more riskier. Or if you want to be a little bit safer and you have less risk tolerance, what you would do is you would wait for it to break below the 38 percentile in this scenario, right? So now if I play this, you could see that we could have entered into two areas. One, right? One would have been right over here, once it broke below the 50 percentile, right? Once as we broke above it, since we broke below it, we could have entered into puts, or we could have also entered it right over here once we broke below 38 percentile. And you could see this basically outlines when to enter into a continuation of a trend, right? Now, since we're on the 4-hour chart, these movements look small, but if you were to actually day trade using these levels, if you were to enter, let's say, right over here for the 50 percentile, you would have probably had a 67% profit. No, probably like close to 100% profit. And if you entered like 38%, if you entered over here and you held to here, for example, like right over here, that would probably be over like 300% profit, versus if you entered over here, it would probably be like 100% profit, right? So obviously the higher entry price you have, the more risk there is, but the more profit there is. So it all depends on your risk tolerance about where you want to enter. So that's basically how you enter for a stock that breaks above the 38 percentile and the 50 percentile, right? Now, how do you enter if it just, let's say instead of breaking past the 38 and the 50, let's say it just rejects off the 38 percentile, right? Well, then you could use multiple things. You can use indicators, right? Like and the indicator you can use is the moving average, right? Let's bring that up. Give me a second. So preferably the 200 MA, right? You could see that. Okay, you can see that BABA retraced into the upside, but even though retracing the upside, it's still below the MA, 200 MA, right? So once we reject the 38 percentile and we start seeing bearish confirmation or bearish candles, you could enter into puts as well. So this is basically how you use the Fibonacci's. Now, of course, you could use it for bullish movements. It's relatively the same thing, right? Except you just plot from the low to high. And let's say in this scenario, right, we could see that this is not a good scenario. Let's try to find another one. Is this a good one? Okay, here's a good one. So we could see here that we plotted the low to the high, right? The swing low to the swing high. And let's say BABA was, give me a second, let me go back to that. Let's say BABA, the current trading day was right over here, right? Oh, sorry. I did that incorrectly. So let's say this is the current trading day right over here, and we plotted our Fibonacci for BABA. We've identified the fact that the trend is bullish. Whoops, that's a horrible line. Okay, whatever. We identified that it's a bullish trend, and we're at a period of cool off, right? Let me draw this arrow over here. And you could see now that we plotted our Fibonacci, what we want to wait for is a reversal into the upside. Now you could see that BABA broke below the 38 percentile and it's approaching the 50 percentile, but we start seeing hesitation and we start seeing a pull into the upside, right? So what I would personally do in this situation I would wait till BABA broke above the 38.2 percentile with good volume, right? So if I continue the replay, I would enter right over here, right? I would enter right over here. Once we broke above the 38.2 percentile level, that's when I would enter for calls, right? That's idealistically when I would want to enter for calls, so I could get on the trend back into the upside, right? And if we play the replay, right, you could see how obviously it continues. Now, there's obviously, as I said, you could use the MA, right, the moving average. I'm using the 200 moving average in this scenario. You could wait till we get the reversal into the upside by using the Fibonacci levels as confirmation, and then the second confirmation is break above the 200 MA, right? As you could see over here, and you can enter into calls, and then eventually we would have broken into the upside, right? So that's basically how you use Fibonacci's. You need to also factor in your risk tolerance. You need to, that's how you decide which levels you enter in, right? Stuff like that. So you guys just start asking questions, because we went over the basics. I believe I have like one more strategy you can use for how to like trade it. You guys can start asking questions in the chat, and I'll start answering the questions that were already asked. So the first question, give me a second, let me post it on Snowpad over here. So this person asks, with Fibs, do you base them over the primary daily movement or smaller changes in ticker, or does it depend? So, okay. Let me try to answer the question. Let me try to answer the way I think you're trying to ask me. So let's say, for example, I'm on the 4-hour or the daily chart, right? Obviously, once the trading day starts, I'm not going to really be looking at the daily chart. I'm going to be looking at the 15-minute or the 5-minute, for example, right? But I could still have the lines for... Actually, could you ask me that question again? I'm a little bit confused about what you're asking, if you don't mind. I'll go on to the next question in the meantime. The next question is... Whoops. Let me get rid of this. I know this seems like a slow process, but I just want to be able to make sure that you guys can see the questions that everyone else is asking, because I'm not sure if it shows the chat when I pull it up. But how far out would you buy your contract since you're on larger time frames? That depends. If you're doing swings, you can obviously, the safest, I will suggest choosing 2 to 3 weeks out for swings, because then the theta decay is lower, right? But you definitely don't want to choose too far away from the you don't want to choose too far out of the money contract if you're choosing 2 to 3 weeks, because then that means that if the stock were to go to the opposite way, you would then your contract would then decrease in value very quickly. So if you're swinging, then obviously 2 to 3 weeks out. But even though you're using a higher time frame, that doesn't mean you can't use this on on a lower time frame. Let's just say, okay, let's say we're still looking at BABA, and we plot a Fibonacci from here to here, right? Now, if we go to the 15-minute chart, right, let's say we're looking at BABA on the 15-minute chart, and we're currently, this is the current trading day. So we drew this Fibonacci on the 4-hour chart. We drew it on a bigger time interval. Now, how do we exactly bring that into a smaller time frame, or basically day trading, right? So when you transition from a bigger time frame to a smaller time frame, your obviously drawings on the bigger time frame are not going to go away. They're going to transition into the smaller time frame. So you can see here on the 15-minute chart, right? This is the current trading day for BABA. You could see that we broke above, which level was this? I believe this is the 38 percentile. Okay, sorry. So we broke above the 38%, right? You could see that this level over here is at 38%. So we're just sitting, we're waiting, right? Since it broke above the 38%, my first rule is okay. When I would enter into puts is if it broke below the 38 percentile level again, right? If it broke below it, that's when I would want to enter into puts. So you would you're not just going to stick to one stock. You could plot all these Fibonacci's on multiple stocks, set alerts, and then once it approaches the level you want to enter at, that's when you would flip onto that chart, right? So that's how you do it. So this current day, we found it doesn't break below, but then you could see the day afterwards, we broke below the 38 percentile. Now, when this happens, you could see that we opened up above it and we start to break below it. Now, this is when you could start getting puts. You could get puts as a day trade, or you could start getting puts as a swing. But since we're looking at a smaller time frame, like the 15-minute chart, we basically classify this as a day trade, right? So by the time your alert triggers, or by the time you enter into the trade, into the puts, right, you probably enter right over here. Now, this is pretty good profits from over here to here, obviously, right? So that's how you enter on a smaller time frame. You just wait for it to break below the level, and that's how you continue. And I mean, not that's how you continue. That's how you trade on a smaller time frame using larger time frame technical analysis. It's for those who are confused about that part. But okay. The next question is, let me bring this up. Okay. The next question is, does the resistance work in the same sense after the point is resisted? So the way I'm understanding what you're trying to ask, right? Correct me if I'm wrong, is let's say this is the level, right? This resistance right here, right? It's a Fibonacci level. That's our resistance we're looking at. You're saying if the stock moved upwards, rejected it, and then came back up to it, does it still classify as a resistance? Absolutely, right? Resistance is just a level where the stock rejects. So as long as the resistance as long as the stock is rejecting at the resistance, then it's considered a resistance. Now let's say the stock broke above it. This resistance now turns into a support, right? So that means that if we were to break above it and then continue downside, there's a high chance that this previous resistance now is turned into a support, can act as a support and push the stock upwards, right? So that's why it's riskier to enter into let's say the stock broke above the 50 percentile, right? Let's say, let's just say Baba broke above the 30. This is the 38%. This is the 50 percentile. So let's just say Baba broke above the 38 percentile and the 50 percentile. And let's say the stock starts reversing into a downside. Now, obviously, the 50 percentile level is going to act as a support. But once we break below it, then it turns back into resistance. And then once we approach the 38 percentile, the reason why entering over here is riskier than entering over here is because the 38 percentile could act as a support. And it could either push the stock up into the upside, or it could push it into the downside, right? And with the choppy market we're having now, it could work either way. That's why this is riskier to enter, because you can, let's say for some reason you don't take profits at this point, your profits could immediately die off if it just bounces off of if it just bounces off the 38 percentile. So that's why it's riskier. If I didn't ask your question, just ask it again in a different way, if you don't mind. The next question is, how do you determine your TP price? Okay. So the question is, I believe what you're asking is, how do you determine your take profit price? Basically the way, so if we go back to here, right, let's say we entered into puts right over here. Okay, we got a little bit of a late entry. It's pretty simple to make profit taking points. If you're taking puts, you'd basically plot out strong supports, and those are your profit taking points. If you're taking calls, you basically plot out resistances, and that would be your profit taking points. So let's say we entered over here, right, into puts. Our first profit taking point would be over here, right? Since this is a strong support right over here, you could see that it touched multiple times, right? 1, 2, 3, 4, right? That's 4 touches. That's pretty strong. And like the next profit point would be like right over here, for example. So that's where your profit taking points are. Now, obviously, if you want to go according to stock price and do these profit taking points, right? Taking profit points, they're going to be a little bit riskier than just going according to option price, right? Because you could see that even though we had a downtrend and we were in profits, you could see it just had a little bit of an uptrend, and this uptrend kind of kills the option price, right? So if you want to be on the safer side, you don't look at the stock price and look at taking profit points or profit taking points. You more look at the option price and take profits at 20% onwards. But if you want to be a little riskier, you just look at PTs or TPs, and then that's where you would exit, you know. Again, that's all your risk to reward ratio, tolerance. But the next question is, so you draw on a bigger time frame and then drill down to smaller time frames to find entries, right? Yes, so that is correct. It depends on the way you look at it. So obviously in the market we're in right now, I absolutely hate it. You guys have been seeing it's difficult for me to even trade in this because it's just absolutely choppy. That BA trade I had today, I had solid technical analysis for it, and it just automatically just did not go the way I wanted it to. But the reason I'm saying that is you can use this for swings. Obviously, swings are more profitable. They yield more profits, but in this market right now, it is absolutely more riskier to do that. Does that mean you necessarily can't do it? Absolutely not. That means you could still do it. It's just you need to be expecting a loss. You know, it's not like 100% chance or a high percent chance that you'll end up with a profitable swing trade. But yes, if you want to, it depends on what you want to do. If you want to swing trade, you could still stick to a bigger time frame. If you're swinging, you don't switch from a big time frame to a small time frame. You just stick to the bigger time frame, or you go to a higher time frame for swings. Now, if you want to day trade, what you would do is you would plot it on a bigger time frame, like I did, and you would shift it to a smaller time frame, like the 15-minute chart, or smaller, right? Let's say you switch to a 3-minute chart, right? If you switch to a 3-minute chart, you could have still entered. You could still entered after this first candle, right? You could have entered right at the second candle, and you could have yielded pretty decent profits. Let's say if you entered here and you just took profits over here, this probably would have been 30 to 70%. I don't know exactly, since each stock's options move relatively different in terms of the option pricing. So yeah. Okay. Okay. So the guy who asked the first question re-asked this question, so let me take another chance at it. It's absolutely not your problem. I'm just slow sometimes. So your question was like, when using the Fibs in a day trading sense, is it okay to use it over like an hour of movement, or should you base it over a large trading period? You could do whatever you want. You could even do like you could plot Fibonacci's on 5-minute, 3-minute, 15-minute. But you have to realize that the less amount of data you have, the more riskier of a trade it is, right? Riskier is not necessarily, the thing is, so people think risky is always a bad thing. It's not. Something is bad if you use it incorrectly. You can use risk in the correct way, right? Like, as I said over here, as I said before, you could enter, like let's say Baba broke above the 30% to 50%, and I said, right, like the riskier entry is obviously entering at the 50%. But that doesn't mean it's the wrong entry to do. You could still enter at the 50%, right, and still profit pretty well. It's just you need to make sure you enter in a risky position using other types of confirmation, right, like other indicators, price action, volume analysis. If you use that, that's fine. So basically, to answer your question, right, let's say instead of looking at like 4 days of data, right, or 4 days worth of candles, you're instead looking at a 1 hour, a period of time that equates to 1 hour, right, 1 hour worth of candles. That doesn't necessarily mean that the Fibonacci you plot on that 1 hour is going to be absolutely not respected. It just means there's a less chance of it being respected. Now, the way you would want to trade, let's say you use an hour of, let's say you use a hour worth of candles, right? An hour worth of candles, and you draw Fibonacci. You'd want to use other indications. You don't go strictly off of Fibonacci's like you easily would be able to on a bigger time frame, right? So hopefully that answers your question. It's not necessarily the wrong thing to do, it's just riskier to do. Okay. Alright, the next question is, when it comes to the TP price, how do you exactly know how much the option price will be based on the stock price? I see a lot of times you have specific prices to exit already. Yeah, so the way I do it, let's go here. Alright, let's see. So let's take this horrible BA loss that we had. Let's say what you're trying to say is, I entered at 140 for BA, right? And then I already set these trims. This is going according to stock price, right? As I said, not stock price, option price. As I said, if you set your trims according to option price, right, or option percent, it's going to be less riskier. So since we entered at 140, 10% of 140 is going to be 154. 20% is 168, 30% is 182, I believe, right? Yeah. So that's how I come up with those prices. That's not according to stock price and me thinking, oh, how much is it going to be? You can never really get an accurate, let's say a stock went from $100 to, let's say again to puts, and the stock goes from $100 to $90. Delta kind of gives you an estimate about where that price will be at, right? But you have to also factor in the volume and the volatility. That also changes the the option price. So you can't necessarily get an accurate price you want to exit the price at. But instead, the safer practice is trimming out or exiting out based on percentages. So once you're in 10% profit, or 20%, right, or 30%, that's when you would scale out or exit the trade so that you're in profits. Hopefully that answers your question. The next question is, so as a scalper, you would use a 15-minute as well? Yes. So as I said, let's go into another stock since we drew a lot on this. Actually, you know what? Let me just remove all of this. Okay. Let's say we're on the 15-minute chart, right? Let's say we took this swing high and we use this swing low, right? You can still use it. You have to use a shorter time frame, and as I said, it's just riskier. You could see that. Let's say the market opened today, right? And we're waiting. We see it breaks past the 38th percentile. See it breaks past the 50th percentile, and then it breaks also past the 61st percentile. Now, I forgot to say, there's two strongest points of resistance, right, where it would reverse into the opposite side, is between the 50% to 78%. And usually it's between the 50% to 61%, but it's also between this area right here. But you could see that we started reversing into the downside, and you could have gotten into puts like once it broke below the 61% around over here, and this would have yielded probably like 30% profit. 30%, yeah, probably 30% profit. So that's how you use it on a shorter time frame. Let's go to another stock. Let's stop looking at BABA. Let's look at everyone's favorite SPY, right? Oh my god, look how ugly SPY has been. Atrociously ugly. Let's go to another stock. Let's go to Apple. Okay. Let's just go over here, for example, right? Now, let's say the trading day is currently over here, right? And we're using the 15-minute chart. What you do is, what I would personally do, okay? What I would personally do is I would set a trigger alert to, whoops, that's not what I meant to do. What I would do is once I identify that the trend is bullish, right, and I start to see a cool off into the downside, I would set an alert. Okay, I'm basically setting an alert over there. I don't know why it's not. Let me do that, probably because I'm in replay mode. But I'll set an alert at the 38th percentile and the 50th percentile, right? And when this happens, I could look at other stocks, right? This is the beauty of it. You could plot these out. You could plot these out on like 20 stocks and set alerts. And the second an alert triggers, that's when you go into the stock. And trust me, the less time you look at a chart, the more accurate and better your trades will be, because the more time you're stuck on a chart, the more hesitation and more emotions are involved into your trades, right? So if you just stick it to a set of rules, then it usually works out more likely in your favor, right? Because you're ruling out emotions in your trading at that point. So you can see here, if I play it, you could see that once BABA hits the 38th percentile, my alert will trigger. So once it triggers, again, we're on the 15-minute chart, right? I guess we could go on a 3-minute chart, since people, actually we'll go on the 5-minute, since a lot of people like using 5-minute. So once we see a trigger off the 38%, once you see the trigger for 38th percentile, I would, let's say, switch to Apple, and I would watch it and I'd see, okay, all right, it's starting to have a trend into the upside. Now, how would you enter? How would you know when to enter, right? This is when you switch into a smaller time frame and you'd plot a Fibonacci on the smaller time frame. Now, what you would look at in this scenario is you would want to look at a breaking of this mini trend right over here, this mini bearish trend. So we would plot a Fibonacci over here, and what I would personally want is it breaking above the 38th percentile, the 50th percentile, or I would wait for it to break above the MA, right? So that's basically how I'd use it on shorter time frames. Now, if you see, like, right, if we wait for confirmation instead of blindly entering right over here when we start seeing a bullish trend, we could save ourselves this loss we would have had, right? So that's why confirmation is everything. You always want to wait for confirmation, because that always gives you what you want. But yeah, okay, here's another question. The next question is, when you talked about setting trims and SL, do you have those trims already working in your orders? And if so, could you slightly go over that? Yeah, absolutely. So let me go back to Discord. Basically, the way it works, right? The way you guys can understand it. When I say I'm looking at a stock or looking at an option, that means I have the chart pulled up for the stock. I'm looking at the stock. I already have my technical analysis drawn, and I'm waiting for an entry point, and I have that option pulled up, right? Now, when I enter, obviously that means I enter, and I say what price I enter at. Immediately after I enter, what I do is I set these trims according to whatever percentage I want. So usually the way it works is right after I enter into trade, I set three automatic trims, and usually that's at 10%. The first trim is at 10%, second trim is at 20%, and the third trim is either at 30% or 40%, right? So that's how I set my trims. And then I set, the way I personally use my stop losses, I don't actually set my stop loss right away. I'm experienced, so I actually don't have emotions in my trading, so I have no problem using mental stop losses by using stock price, right? So let's just say I entered, let's just say I had a horrible entry for calls over here. I would be like, okay, if it breaks below right over here, that's when I enter. That's when I exit my calls, right? So let's say I entered over here. If the stock broke below the level I had set, that, and then I would manually, close all my orders, and I would cancel all my orders, and then sell my position. That's how basically I do my stop losses. But again, since most of you guys, I'm pretty sure, have been only trading for less than a year, I would definitely recommend setting your stop loss according to your risk tolerance, whether it be 20% option loss, 30%, or 40%. But I highly recommend immediately setting the, if you're taking multiple contracts or even one contract, I definitely recommend setting your sell order right away. There's multiple reasons to this. One, it completely removes the emotions of holding on to a contract. Let's say we entered at 140 and it reaches 154. Or no, let's say it reaches 168 and that's 20% profit. That is valid profit taking point. You should definitely take, if you have one contract, like that's a good time to get out. But let's say you don't have that sell limit set, your emotions will kick in. Even though you don't mean to, your emotions will kick in and make you think, okay, it's at 168, I'm at 20%. It can maybe reach 182, which is 30%, or even farther than that. So then you'll likely hold on to the contract. So setting your sell orders right after entry decreases the chance of emotion playing into holding on to contracts. And also there's the fact that if you set your sell limit orders right after entry, there's a much higher chance for your order to get filled, right? I cannot count how many times people have entered a trade and then it would reach, let's say, my scaling point at 154, and it reaches 154 and my options get scaled out, and so do other members, but they will come back to me and say, it reached 154, I tried selling and it didn't get sold. Well, obviously it didn't get sold because you wait for the price to reach that point and then you try selling it, right? You have to realize the way the options, the way it executes is it's first come, first serve, right? It works based on, best price available, right? So if the best price available is 154, if there's multiple orders before you, obviously those orders are going to get executed first versus your late order of 154 after all those orders have been set in place. So that's why you want to set your selling orders right after you enter. That's at least why I recommend it. But hopefully that answered your question. But it is currently 4:25, so that means since we started at 3:30, that means it's approaching 1 hour of the live session. So I definitely don't want to keep the live session long. I'm gonna look to have another live session soon, and I think I'll be going over the Elliott waves for that. And what the Elliott wave is basically it uses the Fibonacci. Let me find it. And you guys probably seen it a few times on my charts. It uses the Fibonacci to, whoops, I did that wrong. It uses the Fibonacci to basically find a trend and stuff like that. So I'll probably go over the Elliott wave next. But you guys could ask me your final questions. If not, then on the live session here itself, I'll give you guys, it's 4:26, I'll give you guys till 4:30 to ask any questions. If not, then you guys feel free to leave. And yeah. What's my schedule to live trade? So it depends. I'm not gonna really go deep into it, but I own a server, and that server I have live trading Monday, Wednesday, and Friday most weeks. Sometimes I have that live trading to the public, to all other servers. So if that's the case as today, right? Like today, you guys will get a message or alert from my channel, whichever server you guys are from, saying that I'm having a live trading session, whether it's just me alone or whether it's just me and another friend that's an analyst, right? You guys will know. But it's usually like last minute, or I'll try to give better heads up if you're not in my server. Fib extensions, yes, they're useful. I have another live session on that instead of because that's that's a little bit more time to explain. The next question is, can you do the fib on FCX? I'm swinging calls a couple weeks out. I want to see how you chart it. Yeah, absolutely. You said FCX. All right, we'll go to 4 hour. Okay, you said you got into calls, right? So what's the first step we'll do? We basically see, I don't know why I said it that way. We identify that the trend is bullish. We could see, man, why is it acting so weird? Okay. We can see that we have a bullish trend and we're having a cool off, right? We project it to be a cool off. Never, ever. Here's the mistake I did when I first started. Never, ever determine something as 100%. We are projecting it to be a cool off. Do not absolutely make it a statement that we're having a cool off, because if you do, you're going to be one-sided, and I promise you, let's say it actually is not a cool off and it's a reversal into the downside, you'll be just so determined into getting calls to continue the trend that you'll just absolutely not see what's before your eyes, right, in that situation, which is basically a reversal into the downside, right? But anyway, that's another story. But so what we do first is we plot from the swing low, which is down over here where my cursor is, to the swing high. Sorry. So the swing low to the swing high, right, which is up over here. And when we do this, you could see that after the cool off, we broke past the 38, the 50, but we have not broken past the 61 percentile. Now, your entry was a risky one, but it's not a bad one. The only thing that I am not liking about this, right, if we were to look at this, is the fact that silk volume factors into it a lot. You could see that the trend is bullish over here, but the volume is decreasing. That's not a good thing. If you guys ever watched my volume video, or if you attended that, you would see that if volume is decreasing towards a certain trend, that means that the trend is not strong. Now, does that necessarily mean that FCX will not go increase to the upside? I mean, not increase, geez. Will continue into the upside? No, that doesn't mean that. It's just saying there's a lower chance for that to happen. So this is why, I would have personally waited for it to break above the 38 percentile. Not saying that your entry was wrong. It also depends on where you entered. Now, if you entered if you let's say entered right over here, right, then it wouldn't have mattered, because that's an amazing entry, because from here to here is obviously like 40% to 80% profit, right? So it depends where you entered. So if you enter like up here or like over here, like recently, then there's a lower chance that's going to continue into the upside. But as I said, the thing that's a little bit worrying is the fact that the volume is decreasing for this bullish movement. So what we could hope is for your swing, or for basically FCX, to break past the 38 percentile. And once we see it breaking above the 38 percentile, right, and volume starts picking up, but you could actually start seeing it picking up right over here. If you look at the mini at a smaller period, right, you could see that the volume is starting to pick up this way, so that's a good sign. But smaller period of times is nothing compared to a bigger period of time, right? So bigger period of time suggests that the trend is not strong, but of course not everything is 100% accurate. So hopefully in your case, we hope that the smaller period of time for the volume data is the one that's going to be dominant, and the volume is going to increase into the upside, and your calls will be profiting pretty heavily. Because if we break above the 38 percentile, then obviously, right, like if I were to enter, my profit taking point, sorry, that's my dog, would be like right over here, and that's a pretty decent profit taking point. If you don't mind telling me like when you entered, I would like to know. But the next question is, with emotions considered, what's a good SL percent to stick to when buying a position, or is it better to base it off of Fib? I can't really answer that because I'm not a financial advisor, right? You just have to look at your I've gone over risk tolerance and risk management multiple times, so I'll go over very briefly. You need to look at your income, you need to look at how much money you have available, and you need to look at how much money you have in a bank account and also in your trading account. Now, if the money that's in your trading account is very vital money, meaning that if you were to, God forbid, lose most of that money or all of that money into trading, then you should definitely have strict stop losses, right? Or at least I would personally have strict stop losses because you wouldn't want to lose most of your money, right? But if this is money that's not, like if you lose most of it, like 60% of it, let's say you lose 60% of your portfolio for some reason, if you lose 60% of it, if it's not gonna just like absolutely put your financial struggles at a high, then you could have bigger stop losses at 30%, right? But I would suggest the sweet spot for stop losses are usually 20 to 30%. That's the best stop losses, in my opinion. The next question is, how long were you consistently profitable before you realize this is something you know how to do? This is a very good question. So basically, in other words, what the question is asking is, how long was I personally consistently profitable to a point like where I could be confident in my own trades and my own technical analysis? Now, the answer is always going to be different to everyone because everyone studies, they study a certain amount. Some people don't study at all. Some people study a lot. Now, if you study a lot, your chances are, the amount of time you have to be consistently profitable is marginally less than those who don't study. Then you also have to factor in the fact of how well you're in control of your emotions. Because if you're not in control of your emotions, it doesn't matter what strategy you use, you will still end up not being as profitable as you would want to be. So I was very well, in control of my emotions for a very long time. I started at the age of 12 when I first started trading. So obviously, like in my first month of trading, I was pretty irresponsible. Not irresponsible, but I took 1K to 24, not 1K, $300 to 24K in a month. But that was just by like full porting and everything like that, right? So that's obviously irresponsible. So I was not in control of my emotions. But then once that 24K profit, just absolutely, I took a bad trade and I did not stick to my stop losses. And I just kept on holding on to contracts. And what happened is that 24K went to 1K. And ever since then, I realized that, okay, I need to be in control of my emotions. And after that, I already had the knowledge because I was studying beforehand and I was learning as I go. And after it became like 6 months of profitable trading, I realized, okay, I could depend on my own technical analysis for my own trades. And that's what happened, right? And after that point, it wasn't like consistent everyday learning and reading on something or watching YouTube videos. It's more looking at the market and making my own observations. And that's what you guys need to do. You need to learn first, right? You need to learn first, realize you need to have control of your emotions, and then you make your own observations. What I mean by your own observations is not by looking at YouTube videos or reading trading material. By the way, I really think trading material is starting to get outdated because the market is very different compared to when these trading materials were actually written. But back to the point, what I mean by observing is I mean by paper trading or actually looking at charts and seeing what I'm talking about, right? So like right here, this is observing. Let's say for FCX, for example, right? I plotted out this fib and I just watched it play out. That is my observation. I am seeing how the stock, um, you know, how the stock basically reacts to different levels to what I drew out or stuff like that or previous drawings. Those are observations. So observations comes after learning material and learning to have control of your emotions. Hopefully that answers your question. Um, but it is approaching 4:40. Does anybody have any last minute questions? Yeah, hopefully that was a great answer. A lot of people, I'll tell you one thing. A lot of people will say this if you ask them. You could have a million trading strategies in your book, in your mind, but it means absolutely jack poop if you do not have control of your emotions. That is 100% a fact. If you give a millionaire $1 million to trade, and he's just like totally irresponsible. He has no trade. Let's say he has trading knowledge, right? He has trading knowledge, but he's very irresponsible. He wants to go for the big bucks. Versus a guy you give just, let's say, $1,000 to. He has some trading knowledge, but he has very, very, very good control of his emotions. In the end, the portfolio growth, of course, like the numbers, the rich guy could obviously, he'll have bigger profits because he has a really big portfolio compared to a $1,000 guy, but the portfolio growth would be bigger on the small account guy because he has better control of his emotions and will less likely get into bad trades. Uh, Someone asked, any good materials or creator aside from you, of course, that you recommend to study or learn from? Reading materials, that's how I learned, but I have to say they overcomplicate things and they're kind of getting outdated. So a year after I read, the initial materials and stuff like that, I realized that the materials I was reading was actually kind of outdated and I had to go based off of my own strategies that I created. So most of these YouTube videos are my own strategies or basically variations of older strategies that are used by institutions and stuff like that. Now obviously as you were saying, creators, what he means by creators is YouTube, right? Now the number one source of learning anything is basically YouTube. Now there are viable, or whatever the right word is, there are good YouTubers out there, but I'm telling you, like 90% of the YouTube creators do not know anything they're talking about, and the only reason why they're putting YouTube videos is one, to get YouTube monetization, or two, to sell a course that they have someone else write up. So I will try looking into what YouTube creators to look at, because I haven't looked into the past few months or years actually. I'm not sure. So I'll look at the follow good YouTube channels and I'll post it on the a live session channel. If you guys have not joined the live session channel, this is again a free neutral server where I'll basically post my my live sessions or my recordings or have any educational information on. All you guys need to do is go onto Discord, find my Discord I almost said portfolio. Discord sorry. Bro, I just wanna Okay, there we go. All you need to do is go onto Discord and make sure you go to this Discord account. Okay, it's $ space, right? There's a space, the market bishop, #888. You go to it, right? And you click on it, and you'll find a Linktree link. If you click on that, it'll take you to this, and then you would go to the free live trading and educational sessions. If you go to here, right? Obviously I'm in the server, but take you to this link, right? It'll take you to Discord. Will basically accept you into this server where you have to accept the rules. To accept the rules, you need to have a phone verified account for your Discord. If you can't get into it, just message this account. But once you get into here, I have the announcements for live sessions. I have the recordings over here, easy accessible. I have important links, very important links, like the compound interest daily compound interesting calculator that I talk about multiple times, personal indicators that I have coded myself, watch lists and other indicators, so on, giveaways and stuff like that. So join here. That's where I'll post the announcements. So for the question of which other good creators I should you should look at, I'll try to find them and I'll post it on I'll probably post it on links, to be honest, or I'll make a new channel for it and say, what's that? I'm sorry, English is not my first language, so I suck. I think I'm using viable right? No, I'm not using viable right, but basically, good good YouTube creators, good YouTube content, good YouTube channels is what I mean. But yeah, it's been a pleasure, but I'll give you guys a minute to ask any questions. If there's no questions, I'll end the live stream here itself. Of course, it's my pleasure to help. I've been a little bit away and inactive from Discord, trading as well. A lot of things have been happening recently, so it was definitely not a good time to trade because I would factor in a lot of emotions to be factoring into my trades, which would cause bad trades, and also it was a very, very choppy market. So, but I'm looking to become a little bit more active, heading into college and stuff like that. So, again, join the live session server. I'll keep you guys updated on when my future live sessions will be. Someone asked, do I mentor people? Yes, I do one-on-ones. You could feel free to message my Discord account for that. It is an expensive price, but of course that's because I teach whatever you want to know. It is $200 per hour, so that's pretty expensive. If you guys want someone cheaper, feel free to message me and I'll give you guys someone cheaper. Yeah. Obviously, the reason I price it that high is because I teach you whatever you want to know. But we don't need to talk about that right now. You can feel free to message me. But it seems like there's no other questions, so I'll end the live stream here. It's been a pleasure talking to you guys.